The ICF Training and Technical Assistance team is honored to welcome you to this California Housing and Community Development training session offered through the Emergency Solutions Grant, Coronavirus Relief Consulting and Staffing Services Contract. I am Chris Pitcher from ICF, and I will be hosting today's session. Today's session is entitled ESG and ESG CV Financial Management Indirect Costs. It is my privilege to introduce today's first speaker, Stephanie Hirschberger. Stephanie?
Hi, good morning. And I want to thank all of you for taking the time today to attend this live session. I know most, if not all of you, have been waiting to move forward with the process for seeking reimbursement of indirect costs. Today's training will begin with an overview of indirect costs, followed by a discussion of the first steps towards achieving that objective. A second training will be held in early December to complete what will be a two-step process to compliantly establish indirect cost budgets and grants network to enable reimbursement of indirect costs. Thank you again for being patient as we sort this all out. With that, I'll turn it back to Chris.
Thank you, Stephanie. It is my pleasure and privilege today to introduce today's presenters, Tyler Bridges and Rudy Munoz. Tyler, please take it away.
Thanks, Chris, and welcome everybody. So we'll begin with the agenda today. The first half of the training, we will review the difference between direct and indirect costs. Then we will review how to calculate indirect costs, followed by Q&A. For the second half, we will review the recent request sent by grant administrators regarding indirect costs and next steps, followed again by another Q&A session. Requirements regarding direct and indirect costs are located in the Uniform Administrative Requirements at 2 CFR 200, and more specifically, the cost principles at 2 CFR 200.412 through 415. So first we'll look at direct costs, indirect costs, and indirect cost methods and rates. So there's no universal rule for classifying certain costs as either direct or indirect under every accounting system. A cost may be direct with respect to some specific service or function, but indirect with respect to the ESG CV award. Therefore, it is essential that each item of cost incurred for the same purpose be treated consistently in like circumstances, either as a direct or an indirect cost, in order to avoid possible double charging of federal awards. Let's start by discussing direct costs. This slide contains the definition for direct costs found at 2 CFR 200.413. The key language contained in the definition for direct costs is underlined and defines direct costs as costs that can be identified specifically with a particular final cost objective, and costs incurred for the same purpose in like circumstances must be treated consistently. This goes back to the comment I made in the prior slide, which is costs must be treated consistently as either direct or indirect cost in order to avoid possible double charging. And note, for the ESG CV program, most expenses incurred by grantees and its subrecipients will be direct costs as opposed to indirect costs. Put another way, direct costs are those costs incurred specifically for the ESG CV award and are not otherwise treated as indirect costs. Examples of direct costs include payroll costs incurred to administer the ESG CV award, supported by timesheets and payroll records detailing the date and time the employee worked on the ESG CV award, costs incurred by grantees' subrecipients performing services solely for the ESG CV award, the purchase of supplies and equipment used solely for the ESG CV award, and direct awards to eligible ESG CV beneficiaries for eligible ESG CV activities. Previously, we indicated that there is no universal rule for classifying certain costs as either direct or indirect under every accounting system, and that a cost may be direct with respect to some specific service or function, but indirect with respect to another. This slide identifies types of costs that can be classified as either direct or indirect, depending on the service or function. In this example, we will look at costs for clerical staff and for computing devices. For clerical staff, the cost is normally treated as an indirect cost. However, it can be classified as a direct cost if the time spent by the clerical staff is integral to the ESG-CV project or activity. It is specifically identified with the project, and it's included in the budget. Likewise, computing devices are often used for more than one program or purpose, which would typically appear as an indirect cost. The Uniform Administrative Requirements at 2 CFR 200.413, however, allow computing devices to be charged as direct costs, even if not solely dedicated to the performance of the ESG-CV award, so long as the devices are essential and allocable to the ESG-CV award. Next, we will discuss indirect costs. This slide contains the definition for indirect costs at 2 CFR 200.1 and states that indirect costs are costs incurred for a common or joint purpose benefiting more than one cost objective and not readily assignable to the cost objectives specifically benefited. Examples of indirect costs include rent and utility costs, accounting and administrative staff, internal audit costs, motor pools, and computers and software. Now, again, costs may be direct with respect to some specific service or function, but indirect with respect to another. And so we had just gone over computers, for example, being able to be either direct or indirect. For the ESG-CV program, and this is important, indirect costs are reimbursable as a percentage of direct costs. We will discuss this in more detail in the next section of this training, but it's important to begin to understand the relationship between direct and indirect costs. The following illustrates an example of differentiating direct costs from indirect costs. So starting from left to right, if staff member A is fully dedicated to the ESG-CV award, then 100% of their salary and fringe benefits, such as healthcare, et cetera, are allocable to the ESG-CV award. Likewise, if staff member B works on ESG-CV and another federal grant, the employee's costs can be split on a pro rata basis using their hours spent per grant documented on their timesheets. Costs incurred by a grantee's payroll and human resources departments, however, are indirect costs since they provide services for all grantee employees, regardless of their role, function, or funding source. For a grantee to charge indirect costs to an ESG-CV award, their standard agreement must require that one of three indirect cost methods are followed and documented. The three methods are the 10% de minimis rate, a negotiated indirect cost rate agreement or NICRA, or a cost allocation plan. Each standard agreement also includes requirements and provisions for charging indirect costs. If a standard agreement allows for indirect costs, grantees must first submit supporting documentation for one of the three options to HCD and receive written approval prior to requesting reimbursement for indirect costs. This will be covered in the second part of this training today. First, we will look at the de minimis rate. Grantees and subrecipients may elect to charge a de minimis rate of 10% of modified total direct costs, which may be used indefinitely. Grantees receiving over 35 million in direct federal funding, however, may not use the 10% de minimis rate. If chosen, this methodology, once elected, must be used consistently for all federal awards until the grantee or subrecipient chooses to negotiate for an indirect rate. Finally, no documentation is required to justify the use of the 10% de minimis rate. Next, let's look at cost allocation plans, which are limited to states, local governments, and Indian tribes, and cannot be used by nonprofits. Most governmental units provide certain services, such as motor pools, computer centers, purchasing, accounting, etc., to operate agencies on a centralized basis. Since federally supported awards are performed within the individual operating agencies, Cost allocation plans provide the process whereby these central service costs can be identified and assigned to benefiting activities on a reasonable and consistent basis. So a cost allocation plan is an accounting report that calculates agency-wide indirect costs to departments and grants that receive services from other departments. It is also a document that identifies and explains the distribution of allowable direct and indirect costs and declares the allocation methods used for the distribution. Finally, each local government receiving $100 million or more in direct federal funding is required to submit a cost allocation plan to its cognizant agency for indirect costs on an annual basis. We will discuss cognizant agencies in just a moment. Negotiated indirect cost rates are like cost allocation plans, but can be used by nonprofits and institutions of higher education. A separate indirect cost rate is usually necessary for each department or agency of the nonprofit claiming indirect costs under federal awards. Grantees and subrecipients wishing to claim indirect costs under federal awards must prepare an indirect cost rate proposal to support those costs. The indirect cost rate proposal is used to calculate the rate expressed as a percentage that can be applied to a program or grant to determine the amount that can be recovered and to justify the establishment of an indirect cost rate. Agencies that receive $35 million or more in direct federal funding must submit an indirect cost rate proposal to their cognizant agency for indirect costs. So what is a cognizant agency? A cognizant agency is the federal agency responsible for reviewing, negotiating, and approving cost allocation plans and indirect cost rate proposals. All negotiated rates must be approved by the grantee's cognizant agency. A grantee's cognizant agency is the federal agency that awards the most funds to the grantee. If awards provided by HUD represent the largest amount of funds awarded by federal agencies, then the cognizant agency is the U.S. Department of Health and Human Services, or HHS. Before we begin to conclude our discussion on indirect costs, please remember, grantees that are able to allocate and charge 100% of their costs directly may do so. And claiming reimbursement for indirect costs is never mandatory. Further, HCD cannot require grantees to use one method over another or prohibit the reimbursement of indirect costs. So this wraps up our discussion on direct and indirect costs. The following are questions or key takeaways for grantees to consider. First, are my agency staff able to differentiate between direct and indirect costs? Does my agency intend to seek reimbursement for indirect costs? And if so, which indirect cost method do we use, and what is our indirect cost rate? Here we see a few resources covering indirect costs. The first is the Uniform Administrative Requirements found at 2 CFR Part 200. And the second two are HUD resources on financial management and indirect costs developed for the ESG program. Next, we will discuss how to calculate indirect costs and the definition of modified total direct costs, or MTDCs. Previously, we stated that for the ESG CV program, indirect costs are reimbursable as a percentage of direct costs. Not all direct costs, however, are used to calculate indirect costs. To calculate indirect costs, grantees need their indirect cost rate and accounting of their modified total direct costs, or again, MTDCs. An indirect cost rate is a tool for determining the proportion of indirect costs each program should bear and is the ratio expressed as a percentage of the indirect costs. Modified total direct costs are the direct costs subject to the indirect cost rate, which we will discuss in more detail in just a moment. So it's important to note that the indirect cost rate is not applied to the overall ESGCB award, but rather certain allowable direct costs, which are also referred to as the direct cost base or modified total direct costs. To calculate indirect costs chargeable to the ESGCB award, grantees must multiply the allowable modified total direct costs by their agency's indirect cost rate. So what exactly are modified total direct costs? The definition for modified total direct costs is found at 2 CFR 200.1 and states all direct salaries and wages, applicable fringe benefits, materials and supplies, services, travel, and up to the first $25,000 of each subaward. Subawards are agreements grantees enter into with their subrecipients. So here we break out the definition of MTDCs more clearly. On the left, MTDCs include direct salaries and wages and applicable fringe benefits, materials and supplies, services, travel, and up to the first $25,000 of each subaward. On the right, MTDCs exclude equipment, capital expenditures, participant support costs, rental costs, and the portion of each subaward exceeding $25,000. Please note, although this definition of MTDCs must be used for grantees utilizing the de minimis rate, grantees and its subrecipients using cost allocation plans or indirect cost rates may use a different cost base to determine their indirect cost rate, and therefore may have a different definition of MTDCs. Therefore, it is important to analyze indirect cost rates and MTDCs on a case-by-case basis. We will discuss this point further in the second part of today's training. Now let's talk about how direct and indirect costs compare to administration and activity delivery costs. It's common to assume that indirect costs are automatically considered administrative costs subject to the administrative cap because indirect costs represent costs such as rent, utilities, agency-wide services such as human resources and payroll. However, since indirect costs represent a percentage of direct costs, grantees and subrecipients incurring direct costs for an ESG-CV funded activity can also incur indirect costs for the activity itself, as opposed to admin. This is referred to as an activity delivery cost, or ADC. ADCs are costs incurred for the implementation, management, or oversight of an eligible activity, like reviewing beneficiary applications for eligibility. Administrative costs are costs incurred for the general management, oversight, and coordination of the ESG-CV award and are subject to the administrative cap. Again, we will discuss this in more detail in the second part of this training. This wraps up our discussion on determining indirect costs. The following are questions or key takeaways for grantees to consider. First, which of my agency's direct costs are MTDCs? And second, how do I determine how much my agency can be reimbursed for indirect costs from the ESG-CV award?
Thanks, Tyler. I'm going to invite Rudy as well to join us on video and to also talk. We have a few questions, but I'm going to answer some general stuff right off the bat. Yes, we are recording this session. Yes, the recording will be posted. We are also going to be able to post the PowerPoint materials for those of you that would like those. So if you have those questions, I've seen a few in the chat. We'll take care of those. I have seen 3 questions come through in the chat. So I'll go ahead and start with those, but we do have a healthy amount of time to have some question and answers. So if you have something burning, make sure you get it in the chat and we will go ahead and address that. But I'm going to start with the first question we got, and hopefully Tyler and Rudy can handle this. It's a pretty dense question. And if not, you'll just tell us and we'll move on to the next one. So in this example, a user wrote in and said, our organization charges a 12% fee to each program to cover several departments, such as human resources, finance, etc. We also have a NICRA of 22.5%. Is an internal transfer in our general ledger of the fee acceptable as indirect costs? Can we use less than what our NICRA approves?
Thank you for the question, and I hope I caught everything there, and I'm going to address this correctly. So, if you have a NICRA, which is a negotiated indirect cost rate agreement, that is the acceptable form that HCD would accept in order to determine and verify your applicable indirect cost rate. Based off of what's called your indirect cost rate proposal, in there, your agency would have specified exactly is allowable modified total direct costs that is subject to your indirect cost rate of 22.5%. So it's likely that salaries and wages that are incurred directly by program staff to oversee the ESG CV program locally, procure services, whatever it is that may be, those would in fact be subject to the indirect cost rate. So as you incur those direct costs and you go to invoice HCD in Grants Network, you would get if the direct costs in that case were $100 that month, then you would also be able to reimburse 22.5% of that, or $22.50 to recoup your indirect costs. So it's not it's not a flat rate. It's always a percentage of what you charge as a direct cost. Then if it's an eligible MTDC, and again, that's in the agreement you worked out with your cognizant agency, then you will be able to recoup those costs on a percentage basis.
Yeah,
Thanks,
just to be clear, I want to make sure that the grantee or subrecipient understands that they need to take a look at their NICRA and what is included there. I thought I heard in the question, I thought I heard it mentioned that it is for other administrative staff and possibly, if I thought I heard correctly, accounting staff. That generally is included as part of the NICRA. So just make sure that you are not counting that twice. If they're not included in your NICRA and they are providing a direct service for that activity, the ESG CV, then as Tyler said, it can be included as part of the calculation.
Thanks, Rudy, and thanks, Tyler. I think the next one's going to be a little bit easier of a question to handle. So we'll toss one out that's not so hard. Cognizant agencies. We had a lot of stuff going on in the chat about cognizant agencies. So I'll just go with the first question I saw. Why would it be HHS if our biggest funder is HUD, is the cognizant agency? Do you want to talk about HHS role as the cognizant agency?
Yeah, I mean, I used to work for HUD. I don't know why they picked HHS. I'll be honest with you, HHS is the cognizant agency for nearly every federal department in the US government. I think Department of Defense or Department of Transportation has a separate cognizant agency. Don't quote me on that. But all other 10 federal agencies use HHS. So I think what the federal government did is say, hey, look, we've got this uniform administrative requirements at 2 CFR 200. They used to be OMB circulars, which also applied to all federal agencies. So let's, for the most part, pick a single agency that's going to review all of these cost allocation plans and indirect cost rate proposals. So it's just, they picked one and it was HHS.
Thanks, Tyler. I thought that would be an easy one. Okay, let's go to a different one. What if we do not use an indirect cost rate? We use a pro rata percentage based on time studies. So if ESG has a 10% on the time study, we would then use 10% of those costs.
So at 2 CFR 200, it does get a little gray when you're starting to break out how to calculate a direct cost versus an indirect cost. So in the example in this presentation where it showed staff member A, B, and C, where we were walking through, staff member A dedicates 100% of their time, staff member B dedicates 50% of their time, and then the human resources department, those were indirect costs. The first two examples were direct costs because they are able to say, I worked 20 of my 40 hours this week on ESG CV, and therefore 50% of my employee costs are allocable or chargeable to the ESG CV award. Now, it sounds like what you've done is just say, based off of past performance, this person typically spends about 10% of their time on the ESG CV award. And so therefore, we do not even bother with timesheets. We just want to charge you 10%. That is not necessarily the way to go. I would have to look at it, and HCD would have to look at it to see exactly what you're doing there and whether or not it's a sound process. The 2 CFR 200 does allow for the ability to do that, but you have to be actually verifying that it is accurate, every quarter or whichever period is appropriate, which means that you do still have to collect timesheets, and every quarter you have to true up whether or not it is averaging 10%. Allocable to the CDBG CV award, and then you must correct it if it is not. So it's not, it may save you some time and maybe make it easier in some instances, but because you really have to true it up as you go along, we recommend that you're better off just charging the actual direct costs as documented on the employee's timesheets.
And Tyler, there was a clarification that we're talking about indirect costs such as an A87 and based on time studies that are allocated each month.
So A87, I believe, is the old OMB circular. If you're referring to that, it is now codified at 2 CFR 200, which would be Appendix 7 and 8. So a lot of the language is the same, but that sounds like you do have a negotiated rate. And so again, I'd really want to take a look at it to see exactly what you're proposing. But if you have completed a cost allocation plan or a negotiated indirect cost rate proposal that has been reviewed and approved by a cognizant agency, then you're good to go with that indirect rate. If you performed an analysis of that sort, but did not get it approved by a cognizant agency, that's where you would be recommended to get it approved by your cognizant agency or begin a discussion with HCD about what options are available to you.
Thank you, Tyler. Okay, I think I understand this question, but if I do not get it correct, please correct me in the chat. Can recipients also take a 10% diminished rate? So in this case, we're getting state HCD admin funds, and we want a 10% indirect cost rate as well.
Yes. So grantees and subrecipients, even HCD, can charge indirect costs to the agency above it. So HCD, the agency above HCD is HUD, right? So the award between HUD and HCD is for the SGCVR award in its entirety, and HCD, based off its indirect, cost rate, is able to charge indirect costs. Just like we discussed just now, grantees may also charge HCD indirect costs on their award. And then one step below that, subrecipients of grantees may also charge indirect costs. Now, if you look at it plainly, you've got 3 layers of indirect costs there, and even more, right? So the subrecipient's charging indirect costs, the grantee is charging indirect costs, and HCD is charging indirect costs. That is why the accounting of indirect costs is so granular and has to be done properly. Because if everybody is charging indirect costs and we don't do it properly, then there's really no money left to actually provide the service or provide, benefit those who are in need of these dollars. And so, again, I just want to state that yes, the everything that we just went over and everything that we're about to go over applies to your subrecipients as well. So HCD is not responsible for reviewing whether or not you got your negotiated agreements right with your subrecipients. HCD will monitor for that, and they certainly will go out there and help you correct that. But just like it's HCD's responsibility to ensure that they're getting your indirect cost rates right, it's the responsibility of grantees to make sure they're working with their subrecipients to get them right.
Yeah, and I will add that just to make sure that you are not charging for the same item twice. So if you're talking about administrative costs, you can't charge it as an indirect cost. And if it's an indirect cost, you can't charge it as an administrative cost.
And the other thing thank you for that, Rudy. The other thing I hear in my head, I hear Rudy's voice saying, document, 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 because that is
Yes.
the key to getting this correct.
Right. And even on the prior question, it's supportive documentation is necessary.
All right. Next question. Are computer equipment and computer software excluded from the MTDC 10% de minimis rate?
So we previously, back in the slides, we said that if you are going to purchase computer equipment, that 2 CFR does have a carve out for that would allow it to be treated as a direct cost. And since it would be treated as a direct cost, then you would also be able to apply 10% on top of that. So 10% because it's a direct cost and it's an MTDC, you get the 10. Oh, sorry. Let me think this through. And Rudy, help me out here. So it's a good question. I may have misspoke. So you can treat it as a direct cost instead of an indirect cost, but it may not necessarily be an MTDC subject to the 10% because equipment is excluded as being an MTDC. Am I following that right, Rudy?
Yeah. So the limit for equipment versus supply is $5,000. So if you purchased a laptop for $5,001, that's now equipment. If you purchased it for $2,000, it's considered supply. And so as a supply, you can charge the de minimis. If it's equipment, you cannot.
Excellent clarification, Rudy. Thank you for that.
Excellent. So another question here, and I think I know the answer, but I want to hear Rudy and Tyler answer it. Are homeless prevention and rapid rehousing rental assistance payments between landlords and tenants excluded from the MTDC 10% de minimis rate?
If you are using the 10% de minimis rate, then those direct awards to beneficiaries is excluded from the indirect cost rate. And so I want to give you an example because this oftentimes causes some contention. If you are operating a program where you receive $10 million from HCD and you are going to, and all 10 million of it is going to go straight to a homeless shelter, let's say, or for a single beneficiary. That entire 10 million, if you were allowed to charge 10% on that, $1 million of it would be going to you in indirect costs. Now think of it in the inverse, where HCD doesn't provide you the actual award, the actual 10 million to give out to benefit those in need, but instead they just give you $100,000 to pay for your staff to actually process these applications. And they say, give us a call when you need to provide that award to the beneficiary and we'll wire it directly to them. Does that mean that because your agency is not getting that $1 million, you are suddenly going to be able to not recover indirect costs? And the answer should be no. You don't need 10% of the money for beneficiaries in order to make sure that your agency isn't going bankrupt because you've accepted this CDB or ESGCV award. You can, however, charge a reasonable amount of direct activity delivery costs. So that 100,000, that is all direct costs for your staff to process those applications, procure, all of the things that it takes for your staff to implement this program and provide those awards to the beneficiaries. You not only get to get reimbursed for those direct costs, but you also do get to charge the 10% indirect on those costs there. So it's not as if you are losing money by not being able to charge the indirect costs on that, $10 million. You're just, what the rules are trying to do here is to prevent excess amount of funds being recouped by local governments that should have otherwise gone to those in need.
Thank you, Tyler. We just have I think we have 5 or 6 questions left, and we do have some time, so we want to go ahead and get through these. I had previously in a nonprofit had a cost allocation plan. Is the limitation of cost allocation plans for governments and tribal entities specific to HUD funding only?
No. So if you look at 2 CFR 200, the rules for preparing cost allocation plans and indirect cost rate proposals are contained in the appendices. And so it's Appendix 6 and Appendix 7. I don't know, Rudy, if you have it available to you. If not, it really does specify. Appendix 6, I think it is cost allocation plans for states, local governments, and Indian tribes. And then Appendix 7 is indirect cost rate proposals for nonprofits and institutions of higher education. So you will see there that the rules are very similar but separate for governments versus nonprofits. They may be calling it a cost allocation plan, but it should be following the rules that are applicable to nonprofits.
Yeah, and so the cost allocation plans is Appendix 6. And if I heard you correctly, Chris, I think the way it was worded was we previously had, which means that under the new, the amended 2 CFR Part 200, they would be eligible for de minimis. If they have an active and approved cost allocation plan or NICRA, then they cannot charge de minimis. Okay.
Until it expires, yeah.
Right.
Thank you for that clarification, Rudy and Tyler. Just a few questions left in this section. And just to note, folks, we are going to a second section that's going to have a second question and answer. This is also about a NICRA, so I'm going to go ahead and just jump into it. We have a NICRA. As long as we provide our rate letter, we should be able to charge more than 10% de minimis rate for the ESGCV program. Our cognizant agency is DHHS. So I think it's just a confirmation that that is absolutely correct.
Yes, it's correct in so many ways. I'm going to give you as many as I can remember. So first and foremost, if you have a cost allocation plan or a negotiated indirect cost rate agreement or a NICRA that is approved by your cognizant agency and it has a rate above, below, or equal to 10% de minimis, you are allowed to charge that percentage, in this case higher, to the ESGCV award on your modified total direct costs, period. So if you were awarded $100,000, that does not mean that, and if your indirect cost rate is 20% instead of 10%, that does not mean that 20,000 of the 100,000 is automatically set aside for indirect, because you have to first determine which of your direct costs are subject to your indirect cost rate. But whatever that rate is, when HC looks at your modified total direct costs, yes, you will be able to use that rate so long as it is approved, signed, dated, and effective. Oftentimes, if it was approved 6 years ago, that is not a current NICRA. And the other points I just wanted to make is HCD cannot refuse any negotiated rate that is currently effective and approved by a cognizant agency, nor can it force you to use one method over the other. The final thing I want to say is that it is against the law for a local government such as yourself or nonprofit to use one rate for one federal award and a different rate for another. And so that is why HCD is required to honor the rate that you have effective for all of your federal awards, including this ESG CV award.
Thanks, Tyler. Anything to add, Rudy? I see you're off mute. I don't know if you, nothing to add. Okay.
Well said.
So we're going to hop to another one. This is actually a follow-up question from our first question. So I'm going to try to get it right. And I'm sure if I don't, someone's going to tell me in the chat. In the event of an audit by either the state of California, HCD, by HUD or HHS, is the agreement the only document you need as justification, or will focus on your parent organization be required? And if you don't remember the first question was about NICRA. So when we talk about an agreement, I believe that would be referring to NICRA.
And I'm Chris, I hate to ask you to read this again, but I didn't quite capture what it is, the relationship between the parent organization.
I also don't have more on that parent organization relationship, Tyler. So perhaps you can just do your best with what I've given you, because I don't think there's any more information I have, unless it comes up in the chat while you're answering the question.
And I'm sure, sorry, Rudy, I mean, I can answer this generically, which is whatever, I see here, the parent organization charges a fee. Okay. This goes back to, I hope I'm going to answer this question to your satisfaction. What is a direct cost versus an indirect cost, and what is subject to your modified total direct costs? So here in this case, you have this fee. If you have a cost allocation plan or a NICRA, negotiated indirect cost rate agreement, you need to first determine whether or not that fee was part of your direct cost base. So was it an MTDC or was it not? Then you'll be able to determine whether or not that cost is a direct or indirect cost, and then how you can charge it to the ESG-CV award. I imagine that would be an indirect cost. So it would just be included in your percentage, and that would be recaptured from the ESG-CV award as a percentage of your direct costs. Rudy, does that sound about right?
Yes. The one question I have, and I'll see if I can answer this without knowing all the details, but I think that if I heard correctly, they want to know if the agreement is the only thing that they would need during an audit. What will likely happen is when HCD or HUD comes out to monitor you to determine your indirect cost, if what you charge as your indirect cost and what you included, more importantly, as your modified total direct cost, lines up with all of your other costs. In other words, if you charged the cost of legal fees to the program as an indirect cost, that you're also not charging it as a direct cost. So when they come out to monitor, the likelihood of them asking you for a copy of your NICRA or your cost allocation plan is going to be very high. Any thoughts on that, Tyler?
No, I agree. And I also just want to specify here that it really, when we're talking about MTDCs, we're using the 2 CFR 200 definition, which is generally applicable to all three methods. It's definitely applicable to the de minimis, but again, you have to look at it on a case-by-case basis. So, the question about direct participant costs, why can't we charge that 10% de minimis? And I gave that answer. But in certain cost allocation plans or in certain negotiated indirect cost rate agreements, if your agency has a history of providing awards of that nature directly to beneficiaries, and you did include that in your direct cost base, then you can charge your percentage indirect cost rate on those costs. So you really do need to look at each agreement and what is and is not part of your MTDCs or your direct cost base.
Thank you both. Rudy, I'm going to send one back to you really quickly because I know you answered it, but I want to make sure I was clear on it. When we talk about the limit on software and equipment, I believe you said that was $5,000. Is that correct?
That is correct. And there's a definition in 2 CFR Part 200 on what the difference between one and the other. And it actually provides a definition for equipment. And then it says anything that is not equipment is a supply. And the threshold is a $5,000.
Great, thank you.
And it's also covered in the financial management training we did last Tuesday.
That is correct. Okay, so regardless of the indirect cost claiming method that is used, we as organizations are still limited to the administrative cap on ESG CV, which we know for CV is 10%, for regular ESG is 7.5%. In that case, we would then benefit from budgeting anything other than the 10% de minimis, since there is no documentation required for this method. So I think this is someone working through, we have administration capped at 10%, but because of documentation, because of ease, de minimis seems to be the most effective way to do indirect costs. Would you like to think on that, Tyler?
There's so many things swirling in my head here. Okay, it is a great rationale, thought process here. So first and foremost, if you already have an active negotiated indirect cost rate agreement or cost allocation plan, then you must use those until they expire. You can't just use de minimis because it's easier, or you cannot use de minimis on this award, but use those indirect cost rates on your other awards. So you must be consistent first and foremost. De minimis is a new byproduct of recent changes to 2 CFR 200 within the last few years. It is, I think, amazing. I think that, it's a great way for subrecipients to recoup indirect costs easily without having to meet the document thresholds that would be required by the NICRAs and the cost allocation plans. So if you are in a position where you don't have one of those two, and you are able to employ the the de minimis rate, then by all means do so that you can recoup those costs. Now, you said that you have this limit on administrative costs. So I'm guessing you're considering whether or not you have enough funds to even charge the de minimis rate, because you're already going to be hitting up against that administrative cap with your direct costs. That in a few slides previously, I described the difference between admin costs and activity delivery costs, where direct and indirect costs can be both admin costs and activity delivery costs. So in an example, I said the cost of reviewing applications of beneficiaries to see if they're eligible to receive wrapping rehousing payments. That is an activity delivery cost. That is not an admin cost. That's not subject to your admin cap. That is just delivering the activity. And so you can charge it to that line item. And then if you're using de minimis, you can charge 10% on those direct costs. And so that's how you recoup that cost, and it never hits your admin cap. So, and then likewise, if you are incurring direct costs against your administrative line item, I don't know, maybe supplies and materials or whatever those eligible administrative costs may be, then you can also charge the 10% against that. If you find, like in most cases, whether you're charging direct or indirect costs or not, eventually you're going to hit a budget cap. And if your costs exceed the amount that you have budgeted, then you'll have to find other eligible sources of funds to recoup those costs. So it's your choice whether or not you're doing that with direct or indirect or both.
Thanks, Tyler. The last two are really just, I think, clarification. So I'm going to start with this one here. Are indirect costs automatically claimed as administration, or are indirect costs with program costs claimed as program? I think you've covered this, that admin and indirect are separate, and program direct costs are separate from indirect and admin, but I think it's worth covering potentially again.
Yeah, and I just spoke to this, and I'll say it once again. So the question may have just been in queue before I answered this question. Direct and indirect costs can be activity delivery costs or the program costs, and also administrative costs. So again, and I'll say this 100 times because it's simple but important. Indirect costs can only be calculated based off of direct costs. So you have to look at what the direct cost is. If the direct cost is a program project cost or an activity delivery cost, then your indirect cost will be the same. It will not be admin. If the direct cost is an administrative cost, then the indirect cost will also be an administrative cost. So you're always looking, what was my direct cost? Was it admin or not? And then was it an MTDC or not? And then now, can I apply my indirect cost rate, yes or no?
And just to be clear, if we would like to, as a nonprofit, to submit a cost allocation plan, that is still something that we could do with HHS, but it is, from what I understand, quite a complicated process. Would you mind speaking to that?
Yes. So if you do not have any current cost allocation plans or indirect cost rate agreements with your cognizant agency, then you can elect to use the de minimis rate until you get this, if in the case you're a nonprofit, your NICRA approved by HHS. That process is long. You'll typically grant local governments and nonprofits that prepare these proposals or these plans hire an accountant to do them. I'm not saying that's required, but they typically do. And then you do have to submit it to HHS. They can provide what's called a provisional rate, which says, hey, we've kind of looked at it. It looks reasonable. Go ahead and use it until we give you your final rate. But even that you're looking at maybe 6, 12, 18 months. Oftentimes, and I can't speak for HHS, but oftentimes these rates are approved after the fact. So each rate is based off of the last fiscal year. So you have to renew them every year. And it will say, okay, based off of last fiscal year, your rate's 22%. This year, it'll be 30%. Next year, it's 10%. We know whatever that might be based off of these proposals you're submitting. And they may not approve it until well into the program year that it's effective for. So it's a messy process and be prepared for that. But in the meantime, you can always use the de minimis. Again, if you don't have active rates previously negotiated. And once you do get the approved rate, if it is effective, if it goes backward, so you've already passed, let's say 6 months of the effective period, you can go back and charge that rate on top of the 10% you already charged. So that the cumulative sum represents the new rate. It's not 10 plus the rate. It's the rate minus the 10%.
Thanks, Tyler. All right, last question, and then we're going to move on to our second section, so folks can get ready. And this is a very California question, so I'm gonna put context around the question because I know the question asker. In the state of California for ESGCB, we have HCD here. We then fund administrative entities who then can fund organizations directly, but in some cases they might be funding someone else who's also funding organizations directly, which is, if you count that many, I think that's 3 sub recipients down. So the gut of the question, again, this feels very California. Can we, as the folks receiving funds from the state of California, can we have a cost allocation plan? But then our subrecipients, the folks that we're actually asking to do the services, can they use de minimis? So can we use different indirect cost methodologies, basically?
The answer it's a good question. The answer is yes. So think about it this way. HCD just gave a presentation today, a training, telling all of its subrecipients, you can pick one of these 3 methods. So we cannot say all of you must use de minimis, or because we use cost allocation, you must use cost allocation. And for the nonprofits, since you can't do it, sorry, right? So just like HCD is allowing its grantees, which are technically subrecipients, all of you, to use one of the 3 methods. When it comes to your subrecipients, they also get to pick one of the 3 methods. And in fact, you cannot require them to use your preferred method or the method that you use. They are required by law to use their method equally, or they must use the same method for all of their federal awards. So no one agency above another, the awarding agency or the pass-through entity, can stipulate which method must be used. They have to use the method that they've already negotiated, or they can elect to use the 10%.
Thanks, Tyler. Thank you, Rudy, both for answering questions. Again, this was just question answering session part 1. We have another presentation to go. So I'm gonna go ahead and move us into that next presentation. Tyler, take it away.
Thanks, Chris. Okay, so we will now begin the second part of the training. First, we will discuss the recent request HCD grant administrators sent to all grantees, which will include each grantee's indirect cost method and rate, how to complete the new budget template, and the timeline for submittal. So on November 9th, which was last week, all ESG CV grantees received an email requesting the following: a completed budget template and an approved cost allocation plan or negotiated indirect cost rate agreement, or NICRA. This information and documentation is necessary to correct budgets and grants network and standard agreements so that grantees can seek reimbursement for indirect costs incurred to date and going forward. If your agency is using the cost allocation plan or negotiated rate indirect cost methods, then you must submit a copy of the plan submitted to the cognizant agency and a copy of the signed agreement between your agency and the cognizant agency, also referred to as a NICRA. The agreement or NICRA must be current and signed by HHS or another authorized cognizant agency, include your agency's indirect cost rate, and include the period the rate is effective. If your agency is using the de minimis rate, then no additional documentation is required. Okay, so now we're going to discuss how to complete the budget template step by step. Again, this information is necessary in order to determine the amount of ESG CV funds your agency can set aside or budget for indirect costs, and is based on the requirements we reviewed during the first part of this training. There are 3 parts to the budget template. The first part is your agency's indirect cost method and rate. The second part is your agency's total budget set aside for your agency and its subrecipients. And the third part is the budget detail, which will allow your agency and HCD to calculate modified total direct costs subject to your agency's indirect cost rate. Okay, part 1 is the easiest. First, you'll insert your agency's name. Second, you'll select the indirect cost method your agency uses from the drop-down menu. And that's the 3 will be listed there. Third, enter your indirect cost rate percentage based on the agreement between your agency and its cognizant agency. If using the de minimis rate, enter up to 10%. And that's it for part 1. So next, we will look at part 2. This section of the budget template requires you to enter the budgeted amounts by eligible activity and agency, which includes your agency and any subrecipients. So in the first line of the first column, enter your agency's name. If you're using subrecipients, enter each subrecipient's name in the remaining lines. If your agency is not using subrecipients, leave those sections blank. Next, enter the amount budgeted per eligible activity to your agency and each subrecipient. The term eligible activity refers to emergency shelter, street outreach, etc., and also includes administrative costs subject to the administrative cap. And that's it for part 2. So the totals will automatically calculate and should add up to your total HCD award, as well as the total amounts budgeted to your agency and each subrecipient, regardless of the number of agreements your agency has with each subrecipient. Any unallocated balances should be entered under your agency's budgets by eligible activity. Okay, so now we'll look at part 3, which will allow your agency and HCD to calculate modified total direct costs subject to your agency's indirect cost rate. This part contains the most detail and therefore we anticipate will generate the most questions. As we discussed in the first half of this training, modified total direct costs vary based on the method selected and the plan submitted to your cognizant agency. For that reason, the budget template will not calculate your indirect budgets at this time. Upon receipt of the budget template and indirect cost supporting documents, HCD will calculate the indirect cost budget and return to your agency for consideration and agreement. Ultimately, what we need to capture here is line item budget detail of every cost type by eligible activity, agency, and agreement number. And again, this is all because of the requirements that we discussed in the first half of this training today. So first, enter your agency name or the name of a subrecipient. Expect to enter each agency's name multiple times for each eligible activity and cost type budgeted to that agency. So in the first column, you may see your agency listed, 6, 8, 10 times based off of the columns that are to the right of it. And the same is true for your subrecipients. Next, in the second column, under agreement number, enter the subrecipient's agreement numbers for each subrecipient. So for example, if you have 2 subrecipient agreements with the same subrecipient, but for different eligible activities, then you would enter the subrecipient's name twice in the first column, then enter the separate agreement numbers in the second column. For your agency, simply enter NA, which means non-applicable. In the next column over, which is eligible activity, for each agency and subrecipient agreement, select one of the 6 eligible activity types. If your agency or subrecipients have funds budgeted for more than one eligible activity, then enter multiple rows so that you enter the total budget per agency, per agreement, and per eligible activity. And again, I apologize. I know this is really detailed, but this is what's necessary in order to calculate and determine and modify total direct costs. Finally, for your agency only, select one of the 7 cost types per eligible activity. So again, we're just talking about the HCD's grantees, so you, not your subrecipients. For your agency only, select one of the 7 cost types per eligible activity. Cost types help HCD determine if the amount budgeted for that cost is a MTDC and includes salaries and wages, which are MTDCs, and equipment, which is not an MTDC. So those are 2 examples of the eligible or the 7 cost types you can select from. For each subrecipient in their agreements, only select subrecipient agreement from the drop-down menu. You do not need to specify all of the cost types for your subs. You only need to specify those cost types for you, the recipient, the direct recipient of ESG CV funds from HCD. So again, for subrecipients, just select subrecipient agreement under cost type per eligible activity. That's it for part 3. Totals will be automatically calculated, and the total at the bottom right should equal your ESG CV award. If necessary, you can add additional rows to the worksheet to enter all your costs by the required criteria in the table heading. So if there's not enough room for you, just add more rows so that you can enter all of the required information. Okay. So now let's look at an example of a completed budget template. In this example, the grantee is Sunny County, and they're using the de minimis rate of 10%. So at the top, they filled out their name is Sunny County. They've selected de minimis from the drop-down menu, and they've entered 10% as the indirect cost rate. Whatever, if you select the other 2 methods and you enter a different percentage, that will be verified by HCD upon receipt of that supporting documentation. So here on this slide, we want to show you that the totals in part 2 and part 3 tables should equal one another and should also equal your total HCD CV award, ESG CV award. This is to ensure that your entire ESG CV award is accounted for. So again, at the top here, you have a table in part 2 and a table in part 3. And at the bottom right of each of those tables, in this example, it's $700,000 each. So when you complete this, make sure that the bottom right total in part 2 and part 3 equal one another, and they also equal the total ESG CV award amount that you received from HCD. Okay, so next, in this example, Sunny County has amounts budgeted to 4 eligible activities and is also utilizing 2 subrecipients, Golden Pathways and Warm Spaces. So first, we're going to look at Sunny County's line item detail in part 3 based on the budgets by eligible activity in part 2. So in part 2, and I know it may be hard to read, Sunny County has amounts budgeted for street outreach, rapid rehousing, administration, and HMIS. That means that Sunny County plans to implement those eligible activities directly. None of that budget is for subrecipients. If they are using subrecipients, and so those are actually identified by eligible and eligible activity and by subrecipient in the 2 lines below. So right now we're just looking at the 4 eligible activity types for Sunny County. So then we're gonna, in part 3, we're gonna begin to break out the line item detail. So for street outreach, 100,000 is budgeted as shown in part 2. Of that 100,000, 85,000 is budgeted for salaries and wages, and 15,000 is budgeted for supplies and materials. Since Sunny County is using the de minimis rate, both budgets can include an amount for indirect costs. So right now, you're not considering whether or not these costs are direct or indirect. You're just entering the total budgets by eligible activity and by cost type. And I just wanted to point out here that those 2 line items are MTDCs based off of the de minimis definition, and therefore you can count on the fact that you will get indirect costs can be charged to that line item. The same concept is true for the remaining eligible activities. So for rapid rehousing, 25,000 of the total $150,000 budget is budgeted for salaries and wages, and 125 is budgeted for direct program participant costs, which would represent direct payments to beneficiaries. In this case, salaries and wages are MTDCs, whereas direct program participant costs are not. So again, we know here that the first $25,000 will include indirect costs, and the second $125,000 will not, based off of the definition of MTDCs. But again, we're not differentiating at this time how much of this budget is direct versus indirect. It's just the total budget. Okay. Finally, for admin and HMIS, Sunny County has just 1 line item for each for salaries and wages. So those would, when calculated, also include indirect costs. So next, we're going to look at Sunny County's first subrecipient, which is Golden Pathways. Sunny County entered into 1 subrecipient agreement with Golden Pathways for a total of $250,000. As shown in the tables in part 2 and part 3, Golden Pathways received $50,000 for homeless prevention and $200,000 for rapid rehousing, which combined totals the total subrecipient agreement amount of $250,000. So again, they had 1 agreement and both eligible activities were contained in that 1 subrecipient agreement. Again, for subrecipients and in part 3, you do not need to enter the budgets for each cost type, since MTDCs only include up to the first $25,000 of each sub-award. So again, if you're using de minimis, you are subject to this definition, and the definition says that you only may recoup indirect costs on up to the first $25,000 of each sub-award, even if it's for $1 million or $100 million. It does not matter. You're capped at $25,000 for that 10% plus up. Since this agreement is for $250,000, the indirect rate of 10% will only apply to the first $25,000 of this subaward, resulting in up to $2,500 that Sunny County can charge as indirect costs for this subaward. Next, we'll look at warm spaces, Sunny County's second and final subrecipient. In this case, Sunny County executed 2 subrecipient agreements with warm spaces, one for emergency shelter funds and the other for street outreach funds. So the difference between the first subrecipient and warm spaces here is the first subrecipient had 1 agreement for both eligible activities. The second agreement, warm spaces, had 2 separate agreements, one for each eligible activity. So like we saw in the last slide, up to $25,000 of each subaward is considered an MTDC. Since these two subrecipient agreements represent two sub-awards, the indirect rate of 10% applies to the first $25,000 of each subaward, which would result in up to $5,000 that Sunny County can charge as indirect costs for these subawards, as opposed to $2,500 in the other situation where the subrecipient had just one subrecipient agreement. Okay, so we are about to wrap here, and then we'll go to open questions. Just 2 or 3 more slides. We know this was a lot of information, and many of you may have questions, so we'll do our best to answer your questions in just a moment. If you have additional questions after today about the budget template or supporting documentation requirements, please direct those questions to your grantee or grant administrator. And to ensure HCD can begin to reimburse your agency for indirect costs incurred today and moving forward, we politely ask that you please submit your responses to the requests at last week by next Wednesday, November 24th. So finally, this slide provides a brief summary of what's next after you respond to your grant administrator's request for the budget template and indirect cost supporting documentation. So once you submit the requested documentation, first, HCD will review the budgets in your standard agreements and in Grants Network. Next, HCD will review the documentation requested by grant administrators that we just discussed. Based on the results of that analysis, HCD will chart a path forward and provide an additional training with more specifics in early December. So this was the, kind of get everybody familiar with the concepts of indirect costs and how to complete the request submitted last week so that we can begin to move forward, and we'll provide another training in a few weeks that will focus specifically on how do we complete this process and move forward. Then HCD will work with each subrecipient to update the budgets and grants network and your standard agreement to allow for the proper accounting of indirect costs. And last, but certainly not least, your agency will then be able to request reimbursement for indirect costs incurred to date and moving forward. That's it.
Thanks once again, Tyler. We'll give you a minute to catch your breath, take a drink of water, get Rudy on. So that was much more about California process and kind of going through the tasks at hand that we have in front of us at the moment. We have a few questions, but I want to set up the entire audience kind of moving forward. That ends our content for today. We have, give or take, 50 minutes left for question and answers. We're going to hang here and answer every question that we can. Some of your questions might be more complicated and we might not be able to answer them today, but we will do everything we can. So keep putting those in the chat, and Kristen and Taylor will keep letting me know that there are more questions to respond to. So again, thank you, Tyler, for all that content. We've got Rudy back to answer questions as well. I'm going to start with, I'm not going to go out of order just because I can. Can an indirect cost rate approved by a state agency, for instance, California DSS, be used for ESG CV?
There is a provision in 2 CFR 200 that does not necessarily require, or that does basically state that HCD would be required to accept a negotiated indirect cost rate agreement under this circumstance. I'm not saying that the answer to your particular instance is wholesale yes, but just based off of the generic question, it can be submitted to HCD for consideration, and it's not off the table. If that's the method you're using and it's already approved by another state agency, if HCD believes that it's valid and usable for this purpose, then they can make that decision. You're on mute, Chris.
I knew I was as soon as I started talking. Thanks, Tyler. As someone to start asking questions that we received that seem more pertinent to the session we just had, I do have some that kind of were part of the first section of the presentation. So I'm going to start down here. Since our award is a sub-award from HCD, does that mean we have an overall $20,000 limit on our entire $5 million grant? I think this was about the example that you were showing on the screen, Tyler.
The subaward, the 25,000 cap. So no, I mean, just like we were talking about, do subrecipients have to use the method that we use? The same is true in this context. So when HCD, first of all, is not using de minimis. I can tell you that. And so they're not doing this whole $25,000 subaward thing. But anything that applies to HCD with respect to how they're they're determining their modified total direct costs does not flow down to you. So it's not as if you're capped by that 25,000. What it's saying is when you look at all of your direct costs and you fill out that budget template, when it comes to your own subawards, so don't even think about HCD, what is your situation? When you're looking at your subawards, if you are using de minimis and you want to recapture 10% of that agreement for indirect costs, it can only be up to 25,000 of that agreement.
Great. There were two questions on that we kind of slammed together, so I think that should have answered two questions at once.
Yeah,
let's try this.
If I can just add real
please,
quickly,
Rudy.
Chris, and that maybe by providing an example, it may help individuals on how they look at this. If you can imagine you're an administrative entity, you receive $1 million of grant funds, and then you subaward. In other words, you're using subrecipients to implement your programs, and the subawards add up to the full $1 million. Okay, now it's not going to happen, but let's just use that as an example. In essence, you aren't doing anything. You're just a pass-through entity. You're passing it along to a subrecipient. The concept is that you should not be able to charge 10% off of that $1 million as, indirect cost, and then charge whatever that happens to be, $100,000 for doing nothing. The idea is that if you are using a subrecipient to do that, you are allowed up to 25,000 maximum to include as a modified total direct cost. And that's not even what you get to draw. That's what you get to include as a direct cost. Wanted to make sure that was clear. Yeah.
It's a great point, Rudy. And it goes back to a similar concept that I stated previously, which is, whether agreement is worth, 100,000 or 100 million, depending on the scope of that agreement, that does not mean necessarily that, that just because you can't recoup 10%, and if you were able to recoup 10% of the 100,000 and 10% of the 100 million, you've got one agreement that is essentially giving you $10,000 in indirect costs and another agreement that is giving you $10 million in indirect costs. Some local counties, a sudden $10 million infusion of cash for your indirect cost services may be completely unreasonable. You're just making money off of indirect costs at that point, because you're not even incurring that much costs. And even when you're spreading it across all your federal awards, the federal government, when they wrote to CFR 200, they knew that instances like these would happen. They're smart people, and it's not to rip anybody off, so to speak. I mean, they want everybody to recoup their fair share of indirect costs, but it is to prevent excesses as well.
Thank you, Tyler. Thank you, Rudy. A few more questions here in clarification that may be helpful to the group. Our understanding is that shared costs, for example, utilities, printing, general use supplies, may be direct charged using an appropriate base.
That's correct. So, and in de minimis, those types of costs are direct costs, supplies and materials, which are as defined by 2 CFR 200, less than, so long as per item per unit cost is less than $5,000, it's considered a supply, which means it would be a direct cost, and then you can get the 10% plus up on that. You just need to make sure that when you are incurring these costs, that you are using them solely for the ESGCB program. So you cannot spend $10,000 buying paper for the entire county and just bill it to ESGCB, right? If you're going to print flyers for street outreach or whatever it is, it's got to be just the 500 or whatever it is you used for the program itself.
Thank you. This is kind of, again, just a clarification for you to speak to. Allowable indirect costs, such as administrative staff time, may be tracked in a pool to support the use of a 10% de minimis. No costs are duplicated, as the pool items are not direct charge to the grant. Is that accurate?
Yeah, so anything that's in a pool is by definition an indirect cost. So you can never charge that as a direct cost because it is an indirect cost. So in order to recoup the costs for that pool, you're charging your indirect cost rate on top of your direct costs. So the direct cost is if I work in a county and I'm procuring a vendor for a particular project, and it took me 6 hours this day to write the RFP, and I make $20 an hour, then that means it costs the county $120 an hour for me to prepare that RFP. Now over in payroll, that cost pool over there where there's 20 staff and they process county payroll for the fire department and the police department, my department, engineering, everybody, that those costs over there are indirect. And so if my rate is 10%, then in order to recoup those costs, then my $120 that I spent today preparing that RFP times 10% means an additional $12 or $132 could be charged to the ESGCB award.
All right, I'm not sure I fully understand this one, so I hope I don't mess it up. Along with our federally approved indirect rate, we also have an approved federal fringe rate that is higher than the 20% allowed. Can we charge the higher approved fringe rate?
HCD would have to take a look at this. When I hear fringe rate, and I'm not sure where this 20% cap is, maybe Rudy, but if you're paid $20 an hour, but you also get health benefits, time off, unemployment insurance, there's a bunch of different things that calculate that are also benefits of being a county employee, pension. And then you're able to calculate what's called a fringe rate. So the cost of your pension, healthcare, et cetera, let's say that adds up to $15 per hour. And your salary is $20 per hour. That's the cash, that goes into your paycheck. So the 20 plus the 15 equals $35 per hour. Which in that case, 15, if $15 is your fringe and $20 is your salary, 15 of 20 is 75%. That's a 75% fringe. That's actually not unreasonable. So I don't know, again, I'm addressing the 20% figure that was cited. But nonetheless, if it's $20 cash in your paycheck and $15 in fringe benefits, then you can charge $35 per hour for that employee for every hour that they write on their timesheets that they worked on this program.
Thank you, Tyler. Okay, I'm going to do my best to sum up this one as well. Our questions are getting longer and a little bit harder, so we'll do my best to get this one down. We have two parts of administration costs. The county administration costs, which we claim 10% of our county's salaries and benefits as allowed. In addition, we have the provider's administrative costs, which are a little more than 10% that the providers have been billing us. Can we claim the full admin costs, somewhere between 12 and 15%, that the providers and subcontractors bill us?
So this does not appear to be related to direct versus indirect costs, but a question about what's chargeable to your administrative cap. So if I'm hearing it correctly, so bottom line is whether or not you as an agency are incurring administrative costs or you're allowing your subrecipients to do so, at the end of the day, the amount that you're capped at is the amount you can bill up to.
Yes, that was my understanding as well. And if not, I'm going to get clarifications in the chat. Okay. We have one more question at the moment. So again, folks in the chat, if you have questions, if you have a very complicated question, you really want to ask it verbally, we can do that as well. We have enough time. So I'm just going to say the process for doing a verbal question, raise your hand, not on camera, but raise your hand in the Zoom app, and we can go ahead and unmute you if you really wanted to ask a very specific question, which I believe this one is going to be, I think, Tyler. So our agency's shared utilities, printing, and general use supplies are allocated to grants based on a direct FTE to the grant with a total agency FTE as the denominator. Our shared costs are similarly direct charged using an appropriate base. Separately, our agency tracks allowable administrative staff time in a pool to support 10% de minimis rate. No costs are duplicated, and we're talking about pools again, as the pool items are not direct charged to the grant. Is this method of allocation applicable? And I'm happy, acceptable. I'm happy to restate that if that was too dense, because it's pretty dense.
Yeah, I mean, I think that the person who asked this question sounds very knowledgeable about the topic. And so just because, I mean, it's a more technical question than I can speak and answer to. It's well written, I should say. You would really have to look at what's going on there. It sounds like, I guess the question is whether or not these methods for distributing to a cost base and distributing it, like how you came up with your amount charged per FTE per hour. So it sounds like supplies and equipment and administrative costs, you're assigning them as instead of a percentage of direct costs, you're assigning them on a per hour worked basis. And if that is true, this gets back to a question we had in the previous Q&A, which is that's where it says, there's an allowance for a reasonable method by which you are determining your indirect costs is allowable. But again, it has to be backed up by supporting documentation, and it has to be updated on a quarterly basis, typically. So those methods are out there, and they're not necessarily submitted to cognizant agencies for review and approval. It's like this gray area. It's a hard question to answer. Unfortunately, I don't know, Rudy, if you can help me out here in any way.
Yeah, so did I hear you correctly, Chris, that they are using de minimis?
I will have to go back through. I see, yes.
Thought I heard
you
say that.
Support the use of 10% de minimis.
Yep.
That's correct.
So at that point, they're going to use the de minimis, and they're going to determine what their modified total direct costs are and calculate by the 10%. Is it an eligible MTDC? I don't know if that makes sense. I know I'm going to make it simpler, but is there more to it than that?
Well, it sounds like, Rudy, what they're doing is they're saying, Tyler, his hourly wage plus friends benefits is $35 per hour. And if we look at all of our employees, we're also looking at our total costs for supplies and equipment. We're also looking at our total cost per human resources and et cetera. And then we're dividing those total costs by the number of hours all of our employees work, so that Tyler's new adjusted $35 per hour is actually $45 per hour, because it's including his pro rata share of all of those costs. So in that case, you would not be able to apply a 10% plus up on top of that, because theoretically your indirect costs are captured in that $10 plus up that you've already calculated. And so if the answer is whether or not that initial calculation is even appropriate, we would have to really look at it specifically on how current it is, how accurate it is, and whether or not it's an appropriate method.
Yeah, you really have to determine what your direct costs are there.
And I also hear Rudy in the back of my head, document.
Yes.
Needs to be able to be seen. It's a very complicated situation. I really appreciate you guys untangling that for us. We have one more question, and then someone has raised their hand to ask a verbal question. So I'm just prompting you that we're going to have a verbal question after this. Okay, so this question came through. For example, our agency expenses are $100,000 that we can claim. 10% indirect on those direct costs and 10% on the first 25,000 of all subrecipients are combined. We have 20 subrecipients in our COC. Does that question make sense?
I think what they're saying is we have an administrative cap of $100,000 and we have subrecipients. We have 20 subrecipients, and if we're able to recoup up to 2,500 of each sub award, that amount may be exceeding our $100,000 admin cap. If that's correct, feel free to clarify in the chat there. But this gets back to whether or not the cost is an eligible ADC versus an administrative cost. So if you have an agreement, or if you have 20 agreements with 20 different subrecipients to do all of the eligible activities, then those are ADCs, right? So that doesn't automatically hit your admin bucket. If for 5 of the agreements are for emergency shelter, then when you go to invoice against emergency shelter for those on behalf of those subrecipients, so you've reimbursed them and now you're seeking reimbursement for HCD. When you also want to recoup your $2,500 per subrecipient up to, you would just bill that to the activity itself, emergency shelter. You would not bill it to your admin line item.
Thank you. The person who asked that question is also asking if they can answer the question verbally. I'm going to go ahead and say yes, but you're coming across as anonymous to me, and I cannot unmute anonymous. I think, is that Pamela Givens? If it's Pamela, say yes in the chat and I will unmute you next. But we are going to go ahead and I'm going to unmute Yolanda. Yolanda, you can now talk. You're going to have to unmute yourself. Go ahead. I don't think we're hearing Yolanda. Yolanda, you want to try speaking again? I think your audio might not be working. Okay, that did not work. Yolanda, if you can help us out in the chat, we'll do what we can to try to make sure you're unmuted. My guess is you're probably working through your computer. Your computer might not have a speaker or a microphone that you're able to talk through, is my guess. I'm seeing you unmuted, but I cannot hear anything. Okay, another question. If we are only charging indirect costs on our admin budget and our cost allocation plan is not based on a rate, do we need to provide a budget by cost type?
You cannot charge indirect costs unless you have an indirect cost rate, and your indirect cost rate is expressed as a percentage, and it can be derived by using the de minimis rate of 10% or by approval through your cognizant agency after having reviewed your cost allocation plan or your negotiated indirect cost rate proposal. So at the end of the day, these are always percentages. We did, that the question that there has been 2 questions today where I said it's a little gray. There is some allowance for, different ways of doing this. And so we have to look at it on a case by case basis. But, with respect to indirect costs, those are the 3 methods.
Thanks, Tyler. All right, I'm going to try one more time, Yolanda, to unmute you and see if we can get you to speak. Yolanda, are you able to talk? Okay. So, Yolanda, we will follow up with you directly one-on-one after this to get to your answer, get to your question rather. I am seeing no other questions, but I'm going to give it one more minute just to make sure nothing else has come across. There's another question that just came through. Who do we send the county indirect cost plan to for review and approval?
So if you're saying if you need it, if it's not approved yet by a cognizant agency, then you need to submit it to your cognizant agency, which is most likely HHS. If it is already reviewed and approved and you're seeking to use that indirect cost rate for your ESG CV award, then you would need to send that approved indirect cost rate proposal and the agreement to your grant administrator here at HCD.
Absolutely. Okay. So I'm not seeing any more questions. We will follow up, Yolanda. We will follow up with you directly. We'll also follow up with Carrie, I believe from Marin County, if I know my California folks, directly afterwards. That folks might have more one-on-one questions that we can answer. I do want to wrap us up today and thank you all for joining us. I also want to thank Tyler and Rudy for covering what is very dense, very complicated questions for indirect costs. This is not an easy concept. I have now been to this training, I think, more than 5 times. I still have questions that I could ask, and I bet you all can as well. So as Tyler said, this is not the last one. We'll be doing another one in December to have more conversation around indirect cost. Your HCD grant administrators are also a resource for you. Ask them questions. They can either answer them or get them to our experts, Tyler and Rudy. So this is not your last opportunity. This really is your a really first opportunity to get those questions answered. So thank you for attending this California Housing and Community Development training session offered through the Emergency Solutions Grant, Coronavirus Relief Consulting and Staffing Services contract. This session is one of over a dozen training sessions that will be posted to the California HCD website, and you can view those at your leisure. We'll now follow up with any questions we didn't answer today, and that now concludes this session.